So, what's your number? We've all been asked that. The entire financial world wants us to chase one giant number. It's sold to us as the finish line, right? You hit that number and boom, you've won the retirement game. But this simple target, well, it hides a really dangerous flaw. See, here's the problem. Just hitting your number is only half the battle. Your actual security, your peace of mind, it depends almost entirely on what the stock market decides to do the day after you retire. And that, my friends, means your future is basically left up to pure dumb luck.
To see what I mean, let's look at a tale of two retirees. They both did everything by the book. They both retired with the exact same amount of money, $1 million. But their stories couldn't be more different. One retired in the year 2000, the other just 3 years later. And that timing, it changed everything.
For the person who retired in 2000, their timing was just a complete catastrophe. The dot-com bubble burst, and in less than 3 years, their $1 million nest egg, it had shrunk to just $600,000. Can you imagine? They watched over 40% of their life savings just evaporate. Now, this isn't just a loss on paper. It's what you call a mathematical death spiral. To pay your bills, you have to sell off pieces of your portfolio. But when prices have crashed, you're forced to sell way more shares to get the cash you need. And those shares, they're gone forever. They can never recover when the market bounces back. So this is the real trap. The old model, the one based on your portfolio's total value, forces you to be a fortune teller. You have to correctly guess where the market is headed. And if you guess wrong, well, the consequences are absolutely devastating. It's a game you just can't afford to lose.
Just think about this for a second. In any other part of life, if you're selling your stuff to pay the rent, it's a huge red flag that you're in financial trouble. But for some reason, when it comes to retirement, we're told this pawn shop strategy is the plan. It just doesn't make any sense, does it?
Okay, so what's the solution? We have to change the goal completely. We need to stop obsessing over the fluctuating price of our assets and instead start focusing on the steady, predictable cash they can generate. It's a huge shift from asset value to income. This is our new compass. It's called cash flow-centric planning. And the idea is simple. You pay your bills with the income your investments generate. It works just like a paycheck did when you were working. Your lifestyle is no longer strapped to the roller coaster of the stock market. So how do we actually do this? It's about changing our mindset. We're not trying to build a fragile nest egg anymore. We are building a powerful income engine, a portfolio designed specifically to generate cash day in and day out. And this isn't some vague dream. It's a real mathematical project. To get from, say, $5,000 a year in investment income to $100,000 a year in 25 years, you just need to grow that income stream by 12.7% annually. That becomes your new, clear targets. And you can break that journey down into small, manageable steps. Instead of chasing a giant $1 million number way off in the distance, your focus is on these smaller, incremental income goals. You can actually see and feel the progress you're making year after year. Okay, so what are the actual building blocks for this income engine? What kinds of investments can do the job? Let's take a look at the tools you can use to make this happen. Here are just a few examples of the kinds of assets that can power your income engine. Now, these probably aren't your typical index funds. We're talking about things like preferred stocks that pay high dividends and different kinds of real estate investments that are designed to generate steady rental income. But these aren't just random tickers. Think of them as strategic players on your team. Each one has a very specific job to do. Some are built to boost income, others provide rock-solid stability, and some can even do well when the overall economy is struggling. Building the engine is step one, but step two is just as important, making sure it can withstand any storm the market throws at it. And for that, you need a clear set of rules for safety and durability. The first rule is simple: diversification. A really good rule of thumb is to own at least 40 different income-producing assets, maybe a few more. This spreads your risk out so that no single failure can sink your ship. When your portfolio is properly diversified like this, each holding only makes up a tiny piece of your total income. So if one of them fails, if its dividend goes to zero, it's a tiny little dent, not a catastrophe. Your main income stream is protected. Now, the second rule is absolutely crucial for growth. You have to reinvest at least 25% of all the income your engine produces. This does three amazing things. It creates automatic growth, it gives you a safety buffer, and it keeps your spending in check.
It's how you make sure your income always outpaces inflation. And this is where the whole approach really flips the script. A big market crash is no longer a disaster that you have to fear. It actually becomes a massive buying opportunity. All those dividends you're reinvesting can now buy way more shares at a huge discount, which actually speeds up your income growth.
So, it all comes down to this one final question for you. Are you building a pile of assets that you'll be forced to sell off piece by piece, hoping you don't run out of money? Or are you building a durable, reliable income stream that will support you for the rest of your life? The choice is yours.